All right. Good afternoon, everybody. My name's Andrew Hastings. I'm the Chief Enterprise Officer of the National Philanthropic Trust. For those of you who aren't familiar, NPT is the largest independent provider of donor-advised funds with over $30 billion in assets, and we've been in the impact investing space for nearly 20 years. I'm here to welcome a great panel of practitioners and experts in the field of impact investing. To my left here is Ron Albahary. He's the Chief Investment Officer at Laird Norton and Weatherby Asset Management, and he was the one who built the impact investing platform at his predecessor firm at the Threshold Group. Next is Kim Leslie Schafer. She is the Senior Policy Advisor of Impact Capital Managers, and she has consulted with groups such as the Harvard Business School's Impact Weighted Accounts Initiative and serves on the board of Just Capital and a credit hedge fund. And finally, Shomik Dhutta, founder and managing partner of Overture, a new $50 million climate tech venture fund. Shomik has worked in the intersection of private equity, climate, and government for over 2 decades. That's their lovely pictures up on the screen there, which is great. Let's see if this thing's going to work. All right. So just to frame things, I think it's really important that the rise of impacting investing is not an accident. It's been coinciding with a growing awareness of the need to address social and environmental challenges. And as more people have become aware of the problems we face, they are also increasingly interested in finding solutions that generate both financial returns and positive impacts, which is why with the right tools and platforms in place, financial advisors will play a critical role in financing the transition to a truly sustainable economy. In fact, there's a report by PwC that recently came out that found that 30% of investors said that they struggle to find attractive and adequate ESG investment opportunities, while 88% of institutional investors surveyed believe that asset managers should be more proactive in developing new ESG products. To provide the proper context for our discussion, we need to have a common language of how we define impact investments. Nick mentioned about three nomenclatures that people use: impact, ESG, and socially responsible investing. We have about 50 people in our audience, and I know if I asked each one of you how you would define impact investments, I would come up with probably 75 different answers. But thankfully, I have Ron here who's going to take us through this slide and show how impact is just one component of a very broad spectrum of investments. Ron.
Thanks, Drew. Good afternoon, everybody. So I know that this can be a pretty confusing space. The taxonomy of terms, the alphabet soup that you hear about is very confusing. SRI, ESG, MRI, there are all kinds of acronyms for what we do here. So we thought this slide actually would at least create some common foundational language for us today. And just think of impact investing really as a subset of sustainable investing and it's just part of the investment landscape. So from left to right, you have traditional investing with no regard for any kind of environmental, social, governance, or values considerations. And then you start the sustainable investing spectrum, starting with exclusionary screening, which really should be just screening in general. Exclusionary screens are things I just don't like. I don't want to invest in fossil fuels, nuclear weapons, and so forth. But you can also have inclusionary screens as well, applied to typically an equity portfolio, things I do want to include, such as best in class within the integrated oil sector for those that are really focused on renewable energy, as an example. Next, you have ESG integration. So that's another form of sustainable investing in which a third-party asset manager is vetting their individual portfolio companies to determine, are those companies incorporating into their operating practices environmental, social, and governance considerations? And if so, are the ways that the company is incorporating those considerations actually accretive to shareholder value? Are they mitigating risk, or are they enhancing returns? And before we go any further, I can tell you that we emphatically believe that incorporating those factors is accretive to shareholder value, and there are lots of studies out there that actually substantiate that. One in particular, you can Google this. It was put out by the New York Stern School of Business and Rockefeller. It's a recent study. It's a meta-study. And it makes the case very strongly that investing in this way can be accretive. Next, you have thematic impact investing. There again, You're not trying to be concessionary in your returns. You don't want to give up financial returns. You're equally weighting the importance of financial outcomes, your returns, as well as the non-financial outcomes related to various themes, whether it's climate investing, affordable housing, food systems, sustainable agriculture, thematic impact investing, which is really what we're going to be talking more about today, is another form on that spectrum. Next, you have catalytic investing. Now that's where an investor wants to subordinate financial returns to the impact outcomes, the issue areas they care about. It doesn't necessarily mean they're going to generate concessionary returns. It just means that they're investing for impact first to draw more capital into a particular theme, into a particular space. They want to be the first mover, the first capital to go in the space. And then last but not least, and we can't forget about it, and it's the purest form of impact investing where you don't want any kind of financial return, and that's philanthropy. So that's the framework that we're going to be operating within today.
And so within that framework, Kim, can you paint a picture for us in terms of the size and scope of the market, the growth of it, and where you're seeing probably the largest points of influence and inference that donors are coming into in this space?
Thanks. And first of all, I just have to pause and say this, Andrew. This is my understanding. It's the first impact or ESG panel at Future Proof, and I want to credit your leadership in creating this panel and trying to bring this theme and education to people. So I tried to quantify for everyone the market, but it really depends on how you define ESG or sustainable or impact. So you can say there's impact over $1 trillion, or by a different definition, it's only 600 billion. That's by and if you look at sustainable investing, that's a different definition. So it depends whether you're including only private capital or public equities. If you include public equities, the U.S. SIF, which is Sustainable Investing Forum, says 1 out of 8 U.S. professionally managed dollars has some sort of ESG integration within it. It also depends whether you're looking globally or just within the U.S. But in all of these numbers that do paint different pictures, it's growth. And also regarding sustainable investing, there's data that suggests outperformance as well, although that's focused on public equities, and a lot of studies related to that. So it's growth and across a lot of asset classes.
And Shomik, in terms of the types of the profile of the clients that are using these funds and the investments, what are you seeing in the space? I mean, in terms of who is it that is really driving these growth? Some of which, I mean, I've seen studies that's as high as 88% over the last few years.
I bring a slightly different perspective to this, which is to say that nomenclature can be confusing. The statistical incidence of extreme weather events are going to intensify unmistakably over the coming decades, and they're going to carry real business risks across drought, wildfires that have turned our sky orange in New York and in California, hurricanes, the incidences of hail and extreme weather events across floods. And candidly, those weather events don't really care about nomenclature so much as they're going to bring pain to the human condition, both in your personal lives and in your businesses. And I think climate represents the single greatest investment arbitrage maybe in the history of modern investing. It will dwarf the size of software. Software globally is about a $600 billion annual revenue business. The industries at stake that have to turn over in climate are 10 trillion in EBITDA. We are talking about decarbonizing the 4 large pillars of modern society in plastics, fertilizer, steel, and cement. And over the next 25 years, we have a regulatory arbitrage opportunity to bet on a global scientific consensus or on some of the business opinion writers in the Wall Street Journal. And you have an ability to invest in some of the most exciting entrepreneurs that are decarbonizing trillions of dollars in EBITDA today that will be embraced, yes, somewhat by voluntary consensus and standards today, but fossil fuels are getting kicked off a regulatory cliff. Starting in the state of California, internal combustion engines will not be available for purchase in the next 10 years. In the state of New York, a new construction build cannot have a natural gas connection. And so when you start thinking about the fossil fuel industry and the natural experiment of extracting fossil fuels and lighting them on fire for the last 100 years, which has been powering our global civilization, I think this is trillions in EBITDA at stake. And I think it's the most exciting investment opportunity of my lifetime, which is why I'm doing it.
So one of the myths about impact investing is that it really is just being driven by millennials and Gen Z. But you can't have this level of growth and impact, and as you're saying, investment opportunity if other generations of clients aren't participating. So is the myth of it being just this new generation that's interested in it, is it true, or is it being driven across the board, both at an institutional level? I mean, are they the drivers, or is it different types of individual clients?
I think it's just techno-economics. A lot of the sort of techno-economics of renewable energy just pencils today. It is just simply cheaper. We are beating coal, diesel, even natural gas. Factoring in the intermittency of solar, solar today is the single cheapest electron you can purchase. And so it is not a standard that is being set. It is not a regulatory burden. It is simply the fact that solar and wind are the cheapest forms of energy today. The total cost of ownership of an electric vehicle is cheaper than an ICE vehicle. And so where you are solving real business pain points, it doesn't give a lick about our jargon. It doesn't give a lick about the fact that the planet is warming, which it is. It is just about solving business pain points. And the fact is that the last 25 years of government subsidy for renewables has made them cheaper, better, and faster today. And I think that same cost curve is starting to hit for lithium-ion batteries and the next generation of renewables and electrified alternatives in the household. And so we're investing against that trend, right? Solar today is about 5% of total US generation in electricity. It's 55% of new generation. If you just look at large deployments in the history of our planet, the single largest deployment was of aircraft carriers in World War II. It was about $400 billion in annual deployment. Solar has already eclipsed that. Solar today has eclipsed a World War II level deployment, and we are just reaching a tipping point where it's going to hit 50% of generation. So I think these are exciting tipping points, and usually the human brain is really bad at estimating exponential growth, and we're hitting these exponential curves right now in climate, which I think is extraordinarily exciting.
Ron.
Just looking beyond climate, just for a moment, you can elevate the discussion to just consider that as wealth advisors, if you're investing in active management, you're paying a manager that has a unique insight to generate alpha, to outperform a benchmark. I can't think of another space that is so confusing, that is so difficult to understand in terms of making the connections related to from environmental and social considerations to investment outcomes, that if you can find managers that have the expertise to exploit those idiosyncratic insights they have, you're going to generate alpha. And so, again, going beyond just climate, you're asking who's investing in this space. Well, real investors that are really thinking about how do we invest in a way that goes beyond the commoditization of investment management, they're actually exploring these areas where there is opportunity to generate excess value for the investment management fees that you're charged.
And I mean, in terms of like an asset class construct, do you look at this as a distinct class? Say, we're looking at, large cap, small cap, and we allocate this on, in private credit, and impact is separate, or is it embedded within the overall asset model where it's like, it's long, like a distressed credit or a long equity?
I'd say the answer is both. At a higher level, incorporating environmental and social considerations when you're making investment decisions, whether you're trying to assess risk or look for opportunities, that's just investing. That's like looking at growth factors, interest rate factors, currency factors, environmental, social factors. So that's just investing. With that said, in the private impact investing space, it is very common for an investor, usually a qualified purchaser or wealthy client, that wants to activate a certain portion of their portfolio in terms of certain thematic impact investments. Those might be segregated off in terms of a sleeve or just as part of their private equity portfolio. But I would absolutely not consider it a separate asset class as a sidecar to the portfolio.
But you see, and Kim, I think this is something for you to address, you're seeing a lot of pushback at a government level at the on ESG and really carving it out separately. Some of what you were saying, Shomik, of like, governments saying we're now getting, forcing people out of the space and looking at BlackRock and other firms and saying we don't want ESG investments in our pension funds, et cetera. But yet, what I'm hearing from the panel is you're doing a disservice to the outsized returns that could be potentially available to you. But where, how do we counteract that? I mean, how is the counterbalance? And is there a regulatory or legislative regime that could impact, on the negative side, the ability for people and institutions to invest in ESG and other impact investment portfolios?
So the first thing is the politicization of ESG is about politics. It's not about investing, it's about politics. And it's about culture wars. And in my view, and allow me to say this, I'm not speaking for impact capital managers in some respects. This is like the SEC disclosure of I'm speaking for me and not representing necessarily the views of an organization. So in my view, although it certainly is the view of most members or all members of impact capital managers, that it's unfortunate that this has become politicized. The ESG has become politicized because it was a blank slate, because people didn't know what it meant, and it was easy to grab onto. The term sustainability is less politicized, and impact is not politicized, at least in my view, and doesn't need to be. So there are a bunch of different regulations that are happening both nationally and across different states. It unfortunately is that in a lot of red states there have been some laws considered that make it more difficult to allocate pension funds, state pension funds, to ESG managers, and those laws don't differentiate. They just say consideration of environmental or social factors. A lot of the laws do have some sort of business rationale exception or outlet, so it's more about the culture war than about actually changing investment dollars primarily. But there's been problems in Missouri in particular. There's a lawsuit, and at the federal level, the House of Representatives has put forward now, as of Thursday, it'll be 8 pieces of legislation that's essentially more difficult for ESG. It's not expected any of those will become law. And some of that relates, a lot of that relates to ERISA or it relates to shareholder voting. So it certainly has gotten complicated and more political, but it's more political. And
can I gently push back on something though, Kim? I'm confused. I always get confused on something. And I read recently that Exxon, which is pulling fossil fuels out of the ground and setting them on fire, qualified with a higher ESG score than Tesla, which is probably the single most consequential, beneficial climate company in the history of modern humanity. And so what is it about those, as a climate investor who's not an ESG investor, none of that's ever made sense to me.
That's all about ESG ratings and ratings that have been provided by different rating agencies and others, and they all have different methodologies, and there's no transparency, and so you have different results. And there's a lot of legitimate criticism, in my view, of ESG and greenwashing or not greenwashing and what's authentic or not. Part of the reason I'm such a fan of impact capital managers is we have standards, and there's real impact measurement and management, and there's transparency related to that, and that's what's important. And the field, the ESG field, does need to move forward. It's at the beginning, and it has problems, and they need to get fixed.
Just one thing to add, just a note of caution for all wealth advisors out there: do not invest based on ESG scores.
Right.
That's the bottom line here. They're imperfect, they're inconsistent, and so that should not be the driver for making investment decisions.
So, Ron, you mentioned the fact that this is an industry and an investment class that is so difficult, to do kind of like the assessment. But when we look at one of the roles a financial advisor plays that's absolutely critical is the due diligence component and serving as that gatekeeper for their client. So, to you and Shomik, like, what are the standards? What are the things that an advisor, a client comes to you and says, listen, I'm trying to align my investment objectives with my personal interests of addressing climate change, right? The climate crisis. How do I go about this? Where do I turn? And as a financial advisor, it's really tough. You don't want to be caught in the deer in the headlights. You see the interest, you're trying to align this. What are the steps you need to take? What are the resources? What are the due diligence standards? I know this will probably be its own session in and of itself, but what are the first steps that an advisor should take?
I can start. Well, first, I think the biggest impediment to progress within the wealth management space is probably the fear that you might have that you don't understand the different aspects of environmental and social issue areas. And to me, it harkens back to when I started back in the industry in 1990 at Merrill Lynch in the financial planning department. So if anybody was around back then, in 1990, there was just a thundering herd of stockbrokers who would call you at night and try to sell you their stock idea. And in the financial planning department, we had to convince those stockbrokers that perhaps the better way to serve clients is to ask them questions about retirement, maybe education, tax planning, estate planning. Those advisors didn't want to do it because they didn't know what questions to ask and they didn't know what to do with the answers. But to me, impact investing, sustainable investing is no different for a client than all of those other issue areas that now are table stakes, like retirement planning and estate planning. You want to ask the client through a discovery process, through your profiling, your planning, what issue areas do they care about? Why do they care about those issue areas? Do they understand that all of these issue areas, like climate, they're all really interrelated because you have a lot of underserved communities that are impacted from a societal perspective by climate. So you don't have to be an expert necessarily, you just have to know what questions to ask. And in terms of what to do with the answer, well, there are lots of providers out here in those tents that probably will help you figure out what to do with in terms of taking the answers that you receive from your client to translate them into some form of a set of portfolio recommendations. I would also urge a lot of you to take advantage of resources like the Sustainable Investment Forum, which is a nonprofit. There are courses online if you want to learn just a little bit more to just get a better sense for the types of questions you should ask and how you should implement portfolios. Last but not least, you can always, most of you probably know Parametric and Aperio out there. Those are providers of screening tools. Now that's the most basic form of impact. I would argue that if clients that want to drive impact probably want to stay closer to the right side of this chart. But with that said, those firms can easily educate you on the profiling process, the questions to ask, and how to implement.
And Shomik, so you're asking the questions, but like one of the challenges, as we know with impact, is truly measuring the outcomes of these funds and these investments. How is it that a financial advisor can assess that effectively, in terms of aligning that client interest with the ultimate social and climate outcome?
Well, they have to. Sorry, I'll finish. Sorry, Shomik. It's really, really difficult to vet managers for the authenticity of their approach to incorporating environmental, social, and governance factors, whether they're investing in the private markets or the public markets. So I'll say that first and foremost. With that said, a lot can be gleaned from just understanding what a manager's theory. If you ask the question, what's your theory of change? When you invest a certain way, what impact outcomes are you trying to generate? Are you reporting on those impact outcomes? If you are, I want to see what you're reporting on. If you're just counting widgets, well, that may not be enough. Tell me some more stories on how nuanced it is to generate impact, and also set the right, if the manager's setting the right expectation, that a lot of impact areas, climate's easier because it's more measurable, but outside of climate, it's hard to measure some of these things. So the more an asset manager can tell stories about the different companies they're invested in and how they're helping those companies drive positive outcomes. Some of this is art and some of it is science, and that's what you have to get comfortable with. There is no perfect answer to vetting a manager and whether they're authentic or not, other than by asking some of the questions I just cited. Sorry, Shomik.
I would say that I take a pretty cold-hearted view on this, which is that the most important metric for me and anybody else in climate, I think the increment of measurement that matters most is simply revenue. And as an investor, I should be graded on my MOIC, on my multiple uninvested capital. How much capital have you given me, and how much capital have I returned you? Because ultimately, I'm a capitalist, and I think the greatest change you can drive through a system is by surprising and delighting a customer with something that is just simply cheaper, faster, and better. It is not, I don't think, ever going to work for me to sell you something that is more expensive, that is unwieldy, that is molecularly different from the commodities you're purchasing if you're a big conglomerate. If we're going to decarbonize cement, for example, we're investors in a decarbonized cement company, I need to produce cement that is molecularly identical to the $2 trillion global cement industry, a drop-in that it just happens to be decarbonized rather than force you to change something new. And so for me, as an asset manager, I think I should be graded on my MOIC. And I think our job in climate and in other impact investment areas is to simply surprise and delight customers with something that is better. And if you can scale impact much faster than by hoping for some kind of special allocation or disposition. And so anyway, yeah, that's sort of my point of view.
Yeah.
Forgive me, that said, for each of you, an important part of impact investing is saying we have an intention to have a certain impact, and we're going to measure some data that is related to or approximates that impact. So that there's something real, so you're not just greenwashing.
No,
and that's important. And what exactly gets measured should depend and relate to the business and to the profit motive of the business.
No, I mean, there has been. I mean, you know, the elephant in the room is, and I think you mentioned it, Ron, in your initial remarks, concessionary rates. I mean, there's this overhang of that within the space, and clearly there are some cases where you are going to have to give up financial return for the impact. But Shomik, you're arguing, if I hear you correctly, it's really like, listen, we're trying to flip that on its head. We're going to do just as good, if not better, returns than what you would get in a traditional investment, while at the same time getting that impact outcome. I guess one of the questions I have is, you know, does it really matter what's driving the decision from the investor, whether it's impact, you know, what's most important to me is the impact quotient or the revenue component, or what should drive that? I mean, at the end of the day.
I think if you want to reach true scale, you have to do the former. And so as an example, you know, I think the two largest levers in climate today are to decarbonize every fossil fuel input, one, and then two, remove carbon from the atmosphere as quickly as possible. The IPCC, the UN body, believes that needs to be 10 billion tons per year, every year for the next 27 years. To put that into context, we removed 6,000 tons last year. So this is going to be a 2 million-x scale-up in carbon removal, or a 72% CAGR, twice the rate of software, over the next 27 years. And so our question is, if you are going to do that, how do you invest in technologies that can beat everybody on price of carbon removal today? And if you're not doing that, who is the company that's going to stand up and say, yeah, I would just love to buy your over-engineered, exotic, expensive thing? You're going to turn the free markets on its head to be able to have to do that. And so, again, like I always start with the first increment of impact for me has to be revenue. Beyond that, I absolutely agree, Kim. You have to measure your gigaton impact of decarbonization or the total tons of carbon that have removed. And we'll grade ourselves on those things, of course. But I don't think I achieve any kind of scale unless I achieve alpha in my returns to my investors, which is the sort of central focus for us as a return-only fund.
One last thing on vetting managers. When you get that pitch book, you're looking for the manager to equally weight their theses related to how they're going to generate financial returns and how they're going to generate non-financial outcomes. And if there's an equal robustness in the pitch deck on both of those issues, you've probably found a manager that's authentic in the space. Very simple heuristic, but I can't tell you how many times I get a pitch book from a manager claiming to invest sustainably, and there's one slide on the impact outcomes, and everything else is related to their investment process.
So one of the things that we've produced here is a list. If the slides would flip, they're not flipping. We did provide. There we go. So these are some resources and research that we compiled in terms of organizations, some of which Ron and the panelists have mentioned, because I think it's really important to help you as financial advisors to be able to, not just draw this from a blank sheet of paper, but there's actually places to go, that there are organizations that are existent today that are in this space that are providing the real hard data and due diligence that are going on in the field. And I would just turn it over to you folks. Aside from what we have here on the screen, there's obviously a number of others. Are there other organizations or research reports that you would add to this list potentially?
Absolutely. Yeah, there's a long list of them. I'll just name a few. For the profiling aspect, so if you want to, let's say, give a portfolio an impact checkup, you may want to look at yourstake.org. It's a fintech tool. It's done a great job of providing advisors with a very simple way to engage in the discovery process, as well as to assess the basic hygiene of a portfolio and to potentially then match it up with a portfolio solution. On the private impact front, citizenmint.com, Josh Heil right here, raise your hand, Josh, CEO and founder, is really trying to democratize private impact thematic investing at very low minimums, at $10,000, for a client that's interested in investing thematically in the private markets. Citizen Mint is a great platform to take a look at as well. And if you're looking for something that's maybe slightly more evolved than a Parametric or a Perio in terms of their questionnaires for screening, Ethic is another fintech out there that's trying to tie together the discovery process and implementation and reporting on investing sustainably from a screening perspective.
Kim.
If you're looking for private capital impact fund managers, market rate returns, authentic impact, best practices of standards in measurement and management, Impact Capital Managers was formed to support and grow this field. It was formed over 4 years ago by 20 managers who wanted to spread the word that this is about collinearity. It's not about concessions. Solving problems, you can make a profit, you can make a good profit, and that's how they were going to invest both venture and private equity. There's also now fund managers who do private debt and real estate, and you can go on the website. The managers are listed. You can sort by asset class, by theme, et cetera, and you also can request some follow-up information about members. But we'd like to consider that we're best-in-class members.
I have 3 books I'd love to recommend. The first is one that I send to all my LPs. It's called Ministry for the Future, which is 50% a dystopian fiction of the world 50 years from now. The opening chapter, is a spoiler alert, they imagine 20 million Indians die because of heat reaching 180 degrees. And as a reference point, Tehran clocked temperatures at 155 degrees Fahrenheit about a month ago. And so that book is fantastic. It alternates between dystopian fiction of the future and the science of today. Second, Bill Gates' book of how to solve the climate crisis is excellent. And third, John Doerr's book, Speed and Scale, will give you a pretty granular look at the sort of central drivers of decarbonization and what we need to do, the major KPIs for how to hit those.
That's great. One thing just for those of you who are in the philanthropic space at MPT, some of the things that we've done, we've partnered with CapShift, to Ron's point of trying to democratize the access of philanthropic capital entering this space. And working with CapShift, we've been able to create thematic portfolios for donors as well as access to private investments with as little as $150,000 in investments. But before we finish off here in the last 4 minutes, we've got a few questions on from the Slido deck. So going to go for the first one here. Question is, why do you think there's been such little uptake of nuclear? And do you believe this is a valid, realistic form of energy production going forward? Somehow I think somebody on our panel might have an opinion on this.
I'm a big believer in miniaturized nuclear. The challenge with grid-scale nuclear today is the cost overruns and the timelines. If you're the CEO of a utility company and you asked your engineering, procurement, and construction firm for a timeline and a cost estimate of a nuclear plant, you will not get a clear answer. And so there's a real business problem with grid-scale nuclear today that is difficult to solve. Now, these next-gen nuclear miniaturized plants are quite promising, and I think you're going to start seeing a lot of off-grid applications for the production of hydrogen and for other energy-intensive use cases. I'm personally a huge believer in nuclear. I think there's this political sort of challenge to solve. One interesting stat you can throw out at your next cocktail party: ask somebody to estimate the total number of deaths at the Fukushima meltdown. The answer is 0, which is surprising.
So the next question is, realistically, building on that, how long will it take us to responsibly wean off carbon-based energy sources and to finally reach critical mass via renewable sources? Where's that tipping point?
Well, the good news is the tipping point is just here. It's a question of how fast we can ride the curve. So as I mentioned before, solar is about 15% of US energy generation today, but 55% of new generation coming online. And that's not because of subsidy, it's because solar is just simply cheaper, faster, and better for the offtake. And so for us, the IRA, the Inflation Reduction Act, coupled with the Infrastructure Bill and the CHIPS Act, represents the most muscular industrial policy we've ever seen in this country since World War II, and that's going to push this even faster. These incentives have not yet hit. This is a $1 trillion wall of money that is now coming for renewables, electric vehicles, and electrifying the home. And to give you some context around this, for renewables alone, those investment tax credits are going to generate around $83 billion in annual tax credits. That's about 17% of corporate tax liability. So we've invested, as an example, in a marketplace called Crux that will connect the developers of renewables to offtake, to private family offices, for example, that might have passive income to offset. And so those types of opportunities, I think, are quite interesting for RIAs. But you know, in terms of timeline, the Paris Accords have set the timeline for us. We have to halve. How do you say that word? Halve our
H-A-L-V-E for those of you spelling in the studio audience.
We have to drive our carbon emissions in half by the year 2035 and to 0 by 2050. And that is the Paris Accord that we and 155 other major countries in the world have signed ourselves up to do.
And so probably time for one question, last question. For impact investors, who sets the standards and who should be setting them? I guess the unstated question is this industry driven or is it government driven or both?
Well, there's an interaction of both. First of all, if you're with impact and you have an intention, you should state what that intention is, and so it's the manager or the portfolio company that's setting the standard. There are quite a number of international and national disclosure standards, like more than you want to hear about. And the SEC is going to come out, for example, with climate disclosure standards for public companies. So having more information, having more disclosure is a first step. But investors should be choosing what they want to invest in and what they care about.
Ron, do you have any comment on that?
I would just say look at what Europe's doing, because whatever they're doing is probably coming here within 2 or 3 years. So there are some organizations that have merged in Europe that are really trying to define a framework. Also here you have SASB, which was named so that it seemed more like FASB, Financial Accounting Standards Board. So SASB merged with IIRC, and they're trying to set some standards for companies. But to the point we made earlier, it's a confusing space. There really isn't one framework. It's evolving. I wouldn't let that scare you from moving forward. There are lots of different ways you can move forward incrementally with clients to serve them well in this space.
As you all know as investors, uncertainty breeds opportunity, and I think that's where this space really is. There's tremendous opportunity and upside in the impact space. Thank you all for attending. Enjoy the rest of Future Proof.
Thank you, Andrew.
Thank you.
Thank you.